Here's what most investors get wrong. They rely on predictions. But the truth is, no one can predict the future. And the people who talk about the future as if they know something is a fact, just as easily as they may be right, they could be wrong. But what if there was a better way? A practical approach that doesn't depend on guesswork, rather statistics. In this video, I'll show you how to be the house with your investments, not the gambler. But first, let me share a bit about myself. I'm Ori, founder of Investing Beyond Stocks, which I started after discovering most of my peers weren't doing anything with their savings. I'm a mechanical engineer by degree, although most of my career I worked in software. A couple of years later, I got my MBA. From a young age, I was taught that your money should be working for you. I remember my dad excitedly telling me about this thing he discovered called stock options when I was in high school. I didn't think much of it back then, but that was my first exposure to the topic, and it definitely planted a seed. I started investing when I was 23, when my dad told me, hey, you have a custodial account. You're now over 18. You should take responsibility for it. And it had about 100 grand, which was way more money than I had ever felt previously in my life. I started out researching, buying stocks, selling them after they went up because I figured I could buy them back when they went down. In short, stupidly and simply trying to time the market. That obviously worked as well as it works for any new investor, which is to say, not amazingly. So I read all the popular forums, newsletters, Seeking Alpha, Money Talks, but kept running into the same problem. All these people, analysts, economists, gurus, they all try to convince you that they know what will happen in the future. This company is good, this segment will do well, whatever it is. But at the end of the day, it's all guesses. For every indicator they quote, there are hundreds of examples where it didn't pan out. Of course, some are right sometimes, and sometimes they get rich and famous from it. But generally, over the long term, no one is successful predicting the future. In fact, if anyone knew for certain any one thing that will happen at a specific time in the future, they could make virtually infinite money. But no one does. The really successful investors over the long term are ones who acknowledge this fact and use a different edge or combination of edges to attain their success. Late one night, a sentence my dad told me back in the day popped into my head. 60% of options expire worthless. Is it true? I don't know. But there was a number in the sentence, something concrete, a probability. And that was the light bulb that went off in my head and was the basis for what turned into my whole investing philosophy. Instead of trying to predict the future, let's keep probability on our side and make money by playing a ton of times. Because that's what casinos do, isn't it? Stack the odds in their favor and get people to play as much as possible. So I did a ton of research, comparisons, calculated probabilities, dove into options investing strategies, tried to tried things out on my real money portfolio because paper trading just doesn't hit the same. I made and lost a bunch of money figuring out what worked and worked less with my skin in the game, polishing my investing premises as I went, which after a time I was able to condense down to three, and an additional three guiding principles. As I've said before, first and foremost, I don't know what will happen in the future. And that's true about me and also everyone as far as I'm concerned. Anyone who says they know what will happen, I'm happy to listen, but I'm very aware that it's their opinion about what will happen, and they may be right and they may be wrong. The second premise is a direct continuation of the first. Because I can't predict the future, also looking backwards, whatever a stock did over any given time, it's possible it would have done the opposite. So if a stock went up 10% last month, it's also possible it could have gone down 10% last month. So on any given investment, what I will do if the stock goes in the opposite direction is just as important as what I'll do if the stock goes in the direction I want. So whatever position I open, I want to have a plan for both outcomes, if the stock goes up and if the stock goes down. The third may sound intuitive, but in practice, if you ask many investors, they may not feel comfortable with it. But it's this. If you wanted to buy a stock for X, you should want to buy the stock even more for less than X. So if you wanted to buy Apple at $200 and then it went down to 150, you should want to buy it even more. If that's not the case, if you wouldn't want to buy more of Apple for $150, then choose a different investment, choose a different company, which if it went down, you would want to buy even more. And then beyond these three investing premises, I have three more guiding principles, which are just as important. First, time in the market is more important than timing the market. And this is an auxiliary to my first main premise that timing the market is impossible. So almost anything is better than trying to time the market. Second, the importance of capital preservation. I would rather gain a consistent 10% than shoot for 30% and then need to start over with half of my money. And the reason this is so important is because of how compounding works. If you start with $100, if you make 10% consistently, you double your money every 7 years. If for some reason you lose 50%, just to get back to your original $100, before we even talk about making money, you need to make 100%. So you just put yourself back 7 years if you accidentally lose 50% of your money. And that's why capital preservation is of utmost importance to me. And then third, aside from all this, the stock market goes up over time. And that's known and it's easy to see in any graph of the market. The market crashed as far back as 1929 during what's known as the Great Depression. But more recently, there was in 2000 was the dot-com bubble. And then 2008, this was the financial crisis. And then 2020, this was COVID, which literally looks like a blip right now. But at the time, people thought the world as we know it was over. And the question of predicting the future is as impossible right now as it ever was. With the S&P up 60% over the last 2 years and at all-time highs, where do we go from here? Do we go up another 30% like last year, taking us to 3 years and 90%? Or do we have a repeat of 2022 where after going up 90% the previous 2 years, the S&P went down 30%? Or maybe we're at the beginning of a 9 year bull run like we had from 2011 to 2020, and honestly beyond, where literally the market did not go down, where even the smallest dip was a buying opportunity. Who knows, right? That's the thing about the future. No matter what just happened, there are examples of all outcomes from here. And let's look at the shorter graph again. And it's actually crazy. The more I look at it, the more it's obvious that anyone who speaks as if they know what will happen is completely deluding themselves. So what do we do? There are a couple of options, and we'll talk about four. The first one is buy and hold. And statistically, over the long term, this is a good strategy. The thing is, the difference in return if you bought just before a drop versus just after a drop can be massive. Just looking back to 2022, which is right here, if you had bought in January 2022 at 4,500 and held until now at 6,000, you would have made 1,500 divided by 4,500, which is 33% over 3 years, or just about 11% per year. But if you had bought in January 2023, which is down here, which is over here, at 4,000 and held until now, you would have made 2,000 divided by 4,000, which is 50% over 2 years or 25% per year, more than twice the previous returns. And while both are completely fine returns, 11% and 25%, the difference is large. And actually, if we zoom out, the question of where you bought is even more important. If you had bought in 2000, you would have lost almost 50% of your money in the next 3 years. And then if you continued holding 5 years later, when you just started to go green, the market crashed again and you lost 50% of your money. So if you had bought in 2000, here you are 9 years later in 2009, and you lost half your money twice. And then it took another 4 years beyond those 9 years till you broke even for the second time. And then after buying in 2000, And then after buying in 2000 at 1500, if you held until 2020, you would have just about doubled your money. So an average of 5% return over 20 years. And as a comparison, if you had bought in 2003 over here at 800, if you held until 2020, you would have made 3.8x over 17 years, or an average of just about 11%, or two times the returns from a difference of 3 years. Or even the most extreme example of luck, if you had bought in 2009, right over here at 750, 11 years later, you would have made four times, so 18% per year average. The point being, buying and holding can be a good strategy if you plan to hold for 10 and up years. But what the market does immediately after you invest plays a critical role in the returns and can vary just in the last 25 years from 5% per year returns to 18% per year returns, which over 20 years is a massive difference. If you had started with $10,000, we're talking about the difference between $26,000 after 20 years and $270,000. So more than 10 times the difference. Let me say that again so it sinks in. 5% returns compared to 18% compounded over 20 years is the difference between 26K and 270,000. $270,000. And this is just the difference between 5 and 18%. It's not 5 and 50%. 5% compared to 18%, that's all. It's a 13% difference in return, and it's causing a difference of more than $240,000. But we have to decide where we are now. And it's kind of obvious. I don't know if we are just I don't know if we are just before a drop, right? Because I can't predict the future, but we're definitely not after a drop, right? Because I can see what happened in the last year and the market didn't drop. It's a fact. So, in the best case, the market continues going up from here for the next 10 years, like it did between 2009 and 2020, or honestly, 2022, and we make a lot of money. But in the worst case, we may be in a situation similar to 2000 or to 2009, where from here the market drops 50%. So, what are some other options other than buy and hold? You can wait, but no one's to say that the market won't go up another 10 to 30% in the coming year, right? As we just saw, we may be at the beginning of a 9-year bull run where the market goes up 300%. It would be a shame to waste 10 years and 300% returns waiting for a market pullback, wouldn't it? Fortunes have been missed out on waiting for a market pullback. But it also would be a shame to buy now and eat a 30% drawdown in the coming year like we had in 2022. Said another way and aligned with our main investing premise, no one knows what will happen in the future. Statistically, in the coming year, the market will do something in the range of minus 30 to plus 30%. But that's a wide range. So what are some other options? There's a strategy called dollar cost averaging. Dollar cost averaging says take the money you want to invest, divide it into a certain number of equal sized chunks, and invest each chunk every certain amount of time. That's a bit amorphous, so let's talk practically. Say I have 100,000 to invest. I can divide that money into, say, 10 chunks of $10,000 and invest each chunk at the beginning of every quarter for the next 2.5 years. What that does is it averages your purchase price over the coming 2 years, where you automatically buy more if the market is cheaper and less if the market is more expensive. Say I want to invest $400 into stock XYZ. With the stock trading at $40, I could buy 10 shares and be done with it. And then, if the stock goes up to $80, I'll make 100%. But if it goes down to $20, I'll lose 50%. And then just to get back to my original $400, I need to make 100%, right? Because I lost half my money. I now need to double my money to get back to even. Or I could dollar cost average by investing $80 every month for the next 5 months. And then let's just look at a theoretical example. If at the beginning the stock is trading for $40, you buy 2 shares. In the second month, the stock went down a little bit. Let's say it's trading at $10, so you buy 8 shares. getting you to $80. In month three, the stock went up a little bit. It's up at $20. So you buy four shares. In month four, it had a great earnings, or I don't know what happened. The stock popped to $80. So you buy one share. And then on month five, the stock went down a little bit. It's back to $40. It's back to the original $40. So you buy another two shares. After 5 months, you've invested $400 and own 17 shares. The average cost per share is $400 divided by 17 shares, which is 23.53. Compared to investing all $400 at the beginning for $40, buying 17 shares for an average cost of 23 compared to 10 shares for an average cost of 40 is a lot better, especially for the future. So looking at the past 5 years, if we had started in January 2022 with the S&P at 4,500, we bought some. Then it went down to 4,250. We bought some more. Went down to 4,000. Bought some more. Overall averaging at, call it 4,250 by January 2023. Effectively, what happened is instead of buying everything at 4,500 just before the disaster that was 2022, we averaged in over the coming year and smoothed our entry point down from 4,500 towards somewhere around 4,200 or 4,250. And that doesn't sound like a huge difference, but still, a 4,250 entry point is better than a $4,500 entry point. And just like the market went up in the next year, instead of going up, it may have continued going down. And that's the question I always ask when evaluating or back testing a strategy. Not if it was successful, rather, how would it have fared in all possible outcomes? And do the advantages outweigh the weaknesses? So for any given year in the future, there are three possible outcomes. The market could go up, it could stay the same, or it could go down. And how would the strategy perform in each situation? And do I feel comfortable with that outcome? Me personally, I feel more comfortable forfeiting outsized returns for losing less in drawdowns. Or said another way, I value capital preservation. So I would prefer a strategy that will make 10% on a year the market went up 20. If it means that on a year the market goes down 10%, I'll stay even. So from the point of view of capital preservation, dollar cost averaging is a better strategy than just buying at market highs, which is where we are right now. At the end of 2022, when the market had just gone down 30%, there could be more of an argument to just buy and hope that the market goes up the next year. But dollar cost averaging would still be considered a better bet for someone whose absolute number one priority is capital preservation. Because again, just like the market went down 30%, the following year it could go down another 30%. Or maybe that's unlikely, but it definitely could go down another 20% or 10%. Just look at the graph of 2000, where it took the market 8 years to recover, or 2008, where it took the market 5 years to recover. So considering right now that we're at market highs and not after a pullback, definitely it seems like the safer way forward, at least from a statistical point of view, would be dollar cost averaging. But are there other options? So the answer is yes, and choosing the right one for you really depends on many parameters, including but not limited to where you are in life financially, what are your investing goals, what is your rate of saving, and many others. And here's where I'd like to introduce one entirely new concept, which you may have guessed from the name Beyond Stocks, and that is stock options. And I know stock options have a reputation of being risky and complicated, but give me a few minutes and I'll explain options with a simple metaphor. Imagine you own a house. It's a $1 million house. That's what it's worth. And you don't want to sell it. But everything has a price. If someone were to offer you 1.5 mil, you may be willing to sell because the value of the house is only $1 million. And if someone will give you 1.5 mil for the house, you can turn around, buy a different house for 1 mil and keep $500,000 profit. But not only is someone offering you 1.5 mil for your house, they will pay you $100,000 for the option to buy your house in the coming year for 1.5 mil. Let me repeat that. They will pay you right now $100,000 for the option to buy your currently $1 million house for 1.5 mil at any time in the coming year. And the year will go by, right? That's inevitable. And then there are two possible outcomes. Either the housing market will go up and suddenly your house will be valued above 1.5 mil, let's say 2 mil, and the person who paid you 100,000 will take your house off of you for 1.5 mil plus the 100,000 that they paid you upfront, sell the house on the open market for 2 mil and book a profit for 400K. Not bad for them, but also not that bad for you because you sold your $1 million house for 1.6 mil. But the other possibility, and in fact probability, because the housing market often doesn't often go up more than 50% in a year, is that the housing market won't go up that much, putting the value of your house somewhere between, say, 1 million and 1.4 million. In which case, the person wouldn't buy your house from you for 1.5 mil. They can just buy a different one on the open market for between 1 and 1.4 mil. In this case, you get to keep your house and also the $100,000 they paid you upfront, in which case you made 10% of your $1 million house for doing absolutely nothing. Okay, that's not true. You make 10% for promising to sell your house for 50% more than it's worth right now. But you make 10% for making a promise. And probability says that it's unlikely that the housing market will go up 50% per year, which means that probably the second outcome is the likely one, the outcome where you make 10%. And even if the unlikely outcome manifests, you still make 60%, which granted is less than the 100% you would have made if you hadn't promised to sell for 1.5 mil and you actually just sold in 2 mil a year later. But still, 60% is a great return. And considering the probable outcome of making 10% in all other scenarios versus making nothing if you didn't sell the promise, selling a promise seems like a good way to stack the odds of making money in your favor. And options on stock work exactly the same way. Someone will pay you money to promise to sell your stock for a certain price over a certain duration. And that way, if the stock doesn't go above that price, you get to keep the money, meaning that you make the money, even if the stock doesn't go up. For example, someone will pay $25 for you to promise to sell Apple stock for $250 over the next year. But in order to promise to sell a stock, you need to own a stock, right? And we're in a situation where we don't own any stocks. We have $100,000 in cash we would like to invest. We don't have any stocks we could promise to sell. So first of all, you could buy stocks and then promise to sell them for a higher price. But there's also another type of option, which I'll explain with another example. Let's say you don't own a house, but imagine there's a $1 million house and it's not yours. You don't want to buy it, and you don't even have $1 million, so you can't buy it, even if you did want to. But either way, you don't want to buy it. But again, everything has a price. If someone was willing to sell it to you for $500, you may be willing to buy, right? Because if the value of the house is 1 mil and someone is offering to sell it to you for 500,000, you can buy it and then turn around and sell it to someone else for 1 million and book a $500,000 profit. But on top of that, what if someone will pay you $50,000 right now to promise to buy the house for $500,000 anytime in the coming year? And again, at the end of the year, there are two possibilities. Either the house will be worth more than 500,000, in which case the homeowner won't sell you the house. It wouldn't make sense to sell it to you if they could sell it in the open market for more than 500,000. But you still get to keep the 50K they paid you up front. So you made 50K for promising to buy something for 500,000, and you can think of it as a 10% profit on the $500,000 cash you had to hold in order to be able to buy the house for 500,000. In technical terms, this situation is described as the option expiring worthless because it gives no value to the person who bought the option at the option's expiration. Or the other possibility is the house will be worth less than 500,000, in which case you'll be forced to buy the house for 500,000 minus the 50K you were paid up front for the house, so 450,000, in which case you just bought a house which 1 year ago was valued at $1 million for $450,000, so less than half price. And then statistically, if last year the house was worth $1 million, probably buying it for 450,000 is a good investment because probably at some point in the future, whatever caused the drop in value will pass, and you'll discover you got a great deal for the house. So compared to the situation where you buy the house on the market for $1 million and then it crashes in half, selling the promise to buy the house for half that much puts you in a much better position for the future. Either you get $50,000 for doing absolutely nothing, or you get the house for less than half what it's valued at right now. And again, options on stocks work exactly the same way. Someone will pay you money to promise to buy their stock for a certain price over a certain duration. And that way, if the stock doesn't go below that price, you get to keep the money, meaning that you make money even without holding stock. For example, someone will pay you $20 to promise to buy Apple stock for $200 over the next year. And when your best case is to make 10% if the option expires worthless, and your worst case is to buy a stock for half of what it is today, is an example of how you can use options to stack the odds in your favor, especially in a situation like today where the market is at all-time highs. If it continues to go up, you still make money, the initial deposit the person pays you for promising to buy their stock. And if the market goes down, you get to buy the stock for significantly less than you would need to pay if you wanted to buy it today. There are many more details how exactly this works, but the mechanics of the example are precise. When I use the term promise, it sounds like there's an agreement which needs to be upheld, but actually the technicalities of how the option and the promise and the purchase and sale and everything happen are all handled by the exchanges. There aren't issues of suing or going to court or upholding your promise or not having the money to cover it. It's all handled by the exchange, the NASDAQ, the New York Stock Exchange, the CBOE, wherever the stock is traded. At any given time, it's possible to buy or sell promises. The deposits are 100% clear and visible. The transactions can be seen. Everything is perfectly transparent. Just as promises can be sold, they can be bought back later. Everything is completely flexible and reversible. And selling a promise to buy a stock for 80, 70, 60, 50% below what it is today enables you to make a little bit of money while the market stays the same or goes up. While at the same time, if the market goes down, buy at a much lower price. Or in other words, selling a promise to buy a stock enables you to make money while waiting for a pullback in the market. In a way, it's exactly like timing the market, but instead of waiting for the market to go down and therefore potentially missing out on 5+ years of an up market, you make money while you wait. So it's better than purely timing the market, but also better than buying at the market if it turns out the market goes down. Now, I know I just dumped a ton of information, and actually, this is just a short introduction to statistical investing as I see it. But if these piqued your interest, I have room for a few new one-on-one clients where I tailor my services to exactly what you need, depending where you are on your investing journey. If you haven't started, I will hold your hand every step of the way, from opening a brokerage account, enabling options trading, making your first trades, as long as you need until you feel 100% comfortable proceeding on your own. If you already have a portfolio of stocks but are worried about performance if the market doesn't continue up from here, we can review your portfolio and discuss ways to use statistics to boost your returns, while at the same time minimizing risk and also optimizing for potential taxes on unrealized capital gains. Or if you are already investing using options but are looking to level up your knowledge, we can discuss more advanced options strategies and ways to adjust positions to boost returns and increase the probability of success. So click the link below to book a free introductory call, where even if you don't decide to proceed with the mentoring services, at the very least, you will get some feedback and tips about how you can get your money to do more.